To you, welcome to the weekend. Before we hit the weekend, I wanted to share with you something that came up in a recent client call. And these are reasons why you don't want to throw all of your money into an IRA or a 401k. Now remember, a lot of financial planners are going to tell you, look, max out your IRA every year and max out your 401k every year, because that is the absolute best thing you can do with your money. I'm here to tell you that that can be a good plan, but it's not the whole story. Let me tell you why. This year in 2023, you can put in $6,500 into an IRA, and that's $7,500 if you're over age 50. You write all that money off against your taxes. Great deal, right? The problem is even though that money grows tax deferred until you retire, anytime age after 59 and a half, when you finally go to pull that money back out, it's totally taxed as ordinary income tax. Think about this. What you're doing is you're shifting your income from this year to a future year. Now that's cool if you're going to make less money in retirement. But what happens if you have a very large IRA, 401k balance, because they both work exactly the same? Every year in retirement, as you pull that money out, that's all ordinary taxable income to you. So what you want to take a look at is you don't want to have all of your eggs just in your IRA and 401k basket, because you could end up with a giant tax bill. Okay? Now remember, even if you don't spend this money and you pass it on to your spouse or to your kids, they're going to have to pay the same tax as well. There's no way around this. So what are your other choices, and what else might you want to consider? I'll tell you this very simply. I have advised clients for 27 years. The best thing that I have seen across all of the clients, all the people I've come into contact with, and all of the wealthy people I've managed money for is multiple streams of income, because it gives you choices. It allows you to say, look, I'll take my ordinary income taxable items like my 401k and my IRAs, and I'll take those out up to certain income levels. Basically, I'll max out my lower marginal tax breaks. I know it's a mouthful, but what it says is I'll take the money out in retirement to a level where I'm not going to pay too much tax on it. But then what do? Where do you get the rest of the money that you need to live on? Because we all know that Social Security, it's not going to be enough, right? Even if it's going to be there for everyone, we certainly hope so, but that remains to be seen. So where else can you take money from, and what should you do today? So here we go. The first is a triple tax-free health savings account. Don't know if you've heard about these, but the limits are $3,850 for individuals, $7,750 for families, and here's what it is. You put the money in today, you get a tax break for it. They give you a debit card, okay? And this debit card can be used for any qualified medical expenses. This includes doctor copays. It even includes aspirin down at the local corner store. It's pretty amazing. This money, you put it in, you get a tax break for it. It grows tax-free, and as long as you use it for those medical expenses, it is spent tax-free. It's a triple tax-free account. Absolutely incredible. Caveat there is you have to have a health insurance plan that's what's called a high deductible health plan, which means that it is going to give you a certain kind of larger deductible, and that's how these HSA plans work. Now, great account. Let's move on. Let's go bigger. Now you can take a look at a Roth IRA. A Roth IRA, very similar to a normal traditional IRA. You put in $6,500. If you're over age 50, it's $7,500, but you get no tax break today, none. The beautiful thing is once you put that money in, it then is tax-free forever. So it goes in, no tax break. But as long as you keep that money in at least 5 years until age 59 and a half, all of the money that you put in, all of its earnings are entirely tax-free to you. If you don't end up spending everything, it goes to your spouse, it goes to your kids, and they don't pay a lick of tax on it either. So Roth IRAs are absolutely incredible. So you have a normal IRA and a 401k where you're deferring your income, right? It's basically don't pay now, but you gotta pay later. A Roth is the exact opposite. It's pay now and never pay again. So I think you can start to see the benefits of doing things like HSAs and Roths, because now if you have all three sorts of accounts, when you go to hit retirement, you can take out from your IRAs and your 401ks at your lower tax brackets. Then you take out the additional funds you need from your Roth IRAs. Remember, a Roth IRA also pairs up with what's called a Roth 401k. And as you would imagine, that gives you some pretty hefty limits. A regular 401k will allow you to put in $22,500 per year. If you're over 50, that's $30,000. The total contribution for employers and employees, this matters if you're self-employed or if you have a very generous employer, goes all the way up to $66,000 a year. In addition, if you're over 50, it's $73,500. So this is really good money that you could throw into a Roth and get that money totally tax-free. All right, so we took a look at two better options potentially to diversify your mix out of just IRAs and 401ks. That's an HSA account and a Roth account, whether it's an IRA or a 401k. Let's go a little bit deeper. Now, I hope I didn't lose you before the weekend, but let me show you what else you can do. If you have your money in a normal taxable account, not a Roth, not an IRA, not a 401k, no special tax features. You just go down to your local brokerage or bank, you open up an account in your name or in the name of your living trust, for instance. That account has no special tax features. Okay, there's no tax rate for putting it in. Pay ordinary income tax on any interest that you earn, and then capital gains on anything you've held over a year will be long-term capital gains, under your short-term capital gains. Okay, no special tax features. But this is where it gets fun. If you put an investment in just a normal account, let's say it's a stock that pays no dividends, you only pay tax on that stock when you finally go to sell it. So if you buy the stock for, let's say, $100 a share and it goes to $1,000 a share, you pay zero tax. When you finally go to sell it, let's say 5 years later, you pay tax on that, let's call it $900 gain, right? But the tax you pay is one of the lowest tax rates we have. It's called long-term capital gains. It can be up to about half of what your ordinary income tax can be. And in some lower tax brackets, it's actually zero. Okay, so long-term capital gains is a great thing. So normal taxable account, no special tax features, but all of a sudden now you can hold an investment in there where you pay no tax until you finally go to sell. They have another nice feature in these just normal basic accounts. That's what's called a full step up at death. So let's just say you buy the same stock for $100, goes up to $1,000. You got what is it? 10 times your money, but you don't need to sell it because you don't need the money, and you just hold it forever. Believe me, I have a lot of older clients that do exactly this. They just hold their stuff because they don't need the money from these particular stocks or these investment accounts. Something incredible happens then when they pass away. When you pass away, you get what's called a full step up in cost basis. What this means, it means you paid $100, worth $1,000. You got a big gain in there. You pay tax on it. But if you hold it when you die, your $100 cost gets a full step up to $1,000, and your beneficiaries pay zero tax. Pretty amazing stuff. So that's a great reason to think about taxable accounts, because you can hold investments, and as long as you don't sell them, you might not be paying any taxes whatsoever. And if they throw off, let's call it qualified dividends, which many stocks will have qualified dividends, those are not taxed at ordinary income tax rates. They're taxed at capital gains rates, which again are dramatically lower. So taxable accounts, don't bat your eye at them just because they don't have the special tax features of, let's say, IRAs or Roth IRAs. They're available to everybody, and they have incredible features if they hold the right investments. All right, now we're almost done. If you're still with me, congratulations. I mean, you really graduated. You deserve everything you get this week, and I hope it's good for you. So what we want to take a look at lastly is real estate, okay? If you hold real estate, I'll tell you right now, very plainly, I've been an investment advisor and a financial planner going back all the way to 1996 now. My wealthiest clients don't just hold assets with me, they also hold real estate. Some of them hold a lot of real estate. Real estate has some incredible tax benefits. So let's just say, for instance, your personal house, you can sell that and you get $250,000 basically tax-free when you go to sell it of gains. If you're married, that's $500,000. That's a great benefit. But remember, if that's held in just a living trust or your normal name, this account or this house, when you die, gets a full step up in basis, just like an asset you held in another taxable account. Okay, so it's great stuff on your personal residence. What about rental real estate? Got great benefits here as well. You buy a piece of rental real estate. Let's say you buy something for $1 million. Let's call it a duplex for $1 million. Okay, you're going to get to depreciate that full $1 million over the useful life of that asset. Okay, that could be up to 39 years. So you're gonna have a small tax break every single year where you're writing off your costs for 39 years. You might say, Travis, okay, it's not very exciting. I understand. Don't worry, it gets better. If you do something called a cost segregation study, what you can do is you go out and hire a third-party firm. So there's lots of firms out there that do this very credibly. And they'll say, look, in your duplex, some of these pieces of the real estate are going to last. The structure, the land, those are going to last the entire time frame. However, some of these items, according to the IRS, depreciate over 20 years or less. And this might be something like the carpets, or it might be window coverings or the water system or something like this that's got less than a 20-year depreciable life. These items, you basically segregate them out. Okay, you get a separate report that says, let's say 30% of that $1 million property is going to depreciate in 20 years or less. If you write that off this year, you get something called bonus depreciation. Let me tell you what that means, because it's an amazing, amazing deal that's offered. And you have to know about it. If you've stuck around this long, you deserve to know about it. Bonus depreciation says that if you have items within your rental properties that depreciate 20 years or less, you can write off 80% of those in year one against all of your other passive income. Let me tell you what this means. You go out, you put 200 grand down on $1 million property, right? So 200 grand down, take out a mortgage for, let's say, 800,000 bucks. Then you do a cost segregation study. $300,000 is what you get to write off 80% this year. So you put in 200, your first year write-off is $240,000, which is 80% of 300 grand. You write that off entirely against all of your rental passive income. Think about that. It's going to zero out your income most likely in year 1, 2, 3, 4, maybe even longer. You keep on carrying that forward until it's entirely used up. So again, huge benefits offered in accounts other than IRAs and 401ks in various sorts of accounts. And remember, rental real estate, personal real estate, other taxable investments all get a full step up in basis, and there's no step up in a regular IRA and a regular 401k. So a lot of advisors out there are going to tell you, look, max this out and then just close the book. And I'll tell you right now, there is a lot more to the story. If you like this, I'll be live streaming for you pretty much daily from here on in. So I wanted to invite you to come by and join, like, subscribe, share with your friends. Have a great weekend.